RBI just made a move that could bring billions of dollars into India. The question is why now? India is not facing any currency crisis. The economy is not collapsing. So why is RBI actively encouraging banks to attract NRI dollars? The answer lies in something far bigger than banking. Because in today's global economy, dollars are not just currency, they are strategic weapon. And that's exactly why RBI has taken this step. The Reserve Bank of India has allowed banks to raise foreign currency deposits under FCNR scheme with special regulatory benefits. First is the RBI will handle the hedging cost. Second, the facility is available until September 30th. At first glance, it may look like routine banking announcement, but the real story runs much deeper. So what has RBI done to attract these dollars? Let's decode. The entire strategy revolves around one account called FCNR. FCNR stands for Foreign Currency Non-Resident Deposit. Under this scheme, an NRI can deposit dollars with an Indian bank. The deposit remains in dollars, the investor earns interest in dollars, and money can be taken back freely. For NRIs, it is a convenient way to keep savings connected to India without taking direct currency risk. Sounds simple, right? Let's understand with example. Imagine an NRI deposit $100,000 when the exchange rate is 86. Now suppose the dollar rises sharply over next year. When the deposit matures, the bank still has to return the same dollar amount. If exchange rate moves significantly, the bank can face currency exposure, and this risk becomes larger when the billions of dollars are involved. So, how do banks protect themselves from the risk? Let's understand. This is where the financial engineering begins. Banks use forward contracts. A forward contract allows the bank to lock today's exchange rate for future date. So even if the dollar rises dramatically later, the bank is protected. The exchange risk is largely hedged, and that makes FCNR deposits manageable for banks. But here is the interesting part. The bigger winner may not be the banks at all. When RBI provides special incentives, banks become more willing to attract foreign currency deposits. That often translate into better deposit rates for NRIs. For overseas Indians, this can mean higher returns, dollar-dominated savings, and access to India's banking system. Which brings us to the biggest question now. If this is such a great scheme, why is it available only till 30th September? Let me answer it. September 30th is not a random date. It makes the half-year closing period for banks. This is when balance sheet, liquidity position, and foreign currency resources become especially important. By encouraging dollar inflows before September end, RBI helps banks strengthen their foreign currency position. To understand why this matters so much, we need to go back in time. Back in 2013, India faced one of its biggest currency challenges. Global investors were pulling money out of the emerging markets. The rupee fell sharply. Foreign exchange markets became extremely volatile. To stabilize the situation, India launched a special FCNR program. The response was massive. Billions of dollars flowed into the country. The move helped strengthen, reserve, and restore confidence. But 2026 is not 2013. And that's where the story changed completely. Today's world is being reshaped by artificial intelligence. Data centers are expanding, semiconductor investments are booming, and technology infrastructure is becoming the new oil. Countries around the world are competing for capital. India wants to position itself as a major destination for global investment. And in that environment, having strong foreign currency resources become a strategic advantage. So the million-dollar question is, will this strategy actually work? Let's see. According to me, yes, because RBI has aligned the incentive for everyone involved. NRI gets attractive dollar returns, banks get cheaper access to foreign currency, and India gets additional dollar inflows. That's a win-win structure. If history is any guide, this move could bring billions of dollars into the banking system over the coming months. And that's exactly what RBI is aiming for. But the bigger question is not whether the dollars will come. The bigger question is what these dollars mean for India's economy and investors. And more importantly, what does all this mean for you as an investor? A stronger foreign currency position generally improves confidence. A stable rupee supports economic planning, and strong banking system enhance financial stability. and confidence often attracts more investment into both debt and equity markets. So here is the bottom line. RBI's latest FCNR move is not a sign of panic. It's a proactive step to strengthen dollar liquidity, support banks, and prepare India's financial system for future opportunities. This is not just about NRI deposits. It's about dollar, banking stability, currency management, and India's ability to attract global capital. The real question is not whether RBI needs those dollars today. The real question is how valuable those dollars could become tomorrow. Do you think RBI's FCNR scheme can repeat the success of 2013? Let me know in the comments. If you found this analysis useful, don't forget to like, share and subscribe. I'll see you in the next video. Thank you.